Walter here. You saved $20,000. Took you maybe 2 years, maybe 3. You did the hard part. You resisted. You said no to things. You drove the car that embarrassed you a little at work. You watched the number climb, slowly at first, then faster toward the end. And then you hit it. 20 grand, clean, yours. And within 6 months, it's gone. Not because you're stupid, not because you got unlucky, because nobody told you that the moment you hit a real savings number, your brain quietly declares war against you. The whisper starts almost immediately. You've earned it. You deserve an upgrade. You've been living like a broke college student long enough, and this is finally your moment to stop. And that whisper, that completely reasonable-sounding, completely human whisper, is what separates people who retire with genuine financial breathing room from people who work until they're 72, wondering where all the years went. I've watched this cycle repeat hundreds of times. Not metaphorically, literally. Across different people, different income levels, different cities. The $20,000 disappears into a nicer apartment, a car payment, a vacation photographed for people they barely know. And then they're back to zero, with higher fixed costs they can't easily cut. The trap is so elegant it almost deserves admiration. Now, before I go any further, this isn't financial advice. I'm not your advisor. I'm a guy who spent decades watching how money actually moves, reading reports most people never see, connecting dots for a living. What you do with any of this is entirely on you. But stay with me, because what I'm about to show you is the part every personal finance video gets right, and then stops. And that stopping point is costing people significantly more than they realize. Not in obvious ways, in quiet, compounding, invisible ways that don't show up until it's too late to correct them. Here's what nobody is doing the math on. You can follow every step in the standard $20,000 playbook perfectly. Every single one. Pay off the high-interest debt, build the emergency fund, max the Roth IRA, buy the index fund, set up the automatic monthly contribution and leave it alone for 30 years. Boring, patient, correct. 30 years later, you've got $350,000, maybe more, depending on how much you keep adding every month. By every conventional personal finance measure, you won the game. But here's the question I want you to actually sit with today. What is $350,000 worth in 30 years? Right now, as I'm recording this on February 17, 2026, gold is trading at approximately $4,960 an ounce. 3 weeks ago, it touched $5,602, an all-time record high in history. Silver hit $121 an ounce on January 29th, before one of the most dramatic sell-offs in precious metals history dropped it nearly 50% in under 2 weeks. Right now, it's around $82, and as I'm recording, it's actually bouncing sharply, up over 7% in early trading this morning alone. The US dollar index is sitting at 97, well below where it was 12 months ago. China's central bank has now bought gold for 15 consecutive months, not 14, 15, in a row, without a single month off. And the S&P 500 is at 6,836. I'm going to show you why all of those numbers belong in the same conversation. Why the index fund plan and the gold price are not two separate worlds aimed at two different kinds of investors. They're the same conversation, approached from different angles. And if this kind of thinking, connecting the personal finance world to the macro picture that nobody in the budgeting space ever addresses, is useful to you, hit subscribe. I do this every single day, and I promise it's worth your time. So let's start where the standard framework starts, because the foundation is genuinely solid, and I want to be fair to it before I add what's missing. You've got $20,000. The first question is whether you're carrying high-interest debt. And I mean real high-interest debt. Credit cards running at 20, 21, 22%. If yes, the math is brutal and simple. You are paying a guaranteed 22% to earn a potential 10% in the market. That is a losing trade every single day you allow it to continue running. Pay it off first, not alongside investing, not after you see how the market does this quarter. First. Every dollar you direct toward a 22% balance earns you a guaranteed 22% return. You will not find that return anywhere on any exchange. Here's something that came out 11 days ago, something no video recorded before this week could have included. On February 6th, a bipartisan coalition formally pushed legislation to cap credit card interest rates at 10% for 5 years. The 10% Credit Card Interest Rate Cap Act, Senators Sanders and Hawley, Representatives Ocasio-Cortez and Luna. That's the full ideological spectrum in the same room, behind the same bill. The proposal is estimated to save working families $100 billion every year. That figure comes directly from their own analysis. It's on public record. Right now, this is legislation, not law. But if it passes, the math on debt payoff changes. If your 22% card becomes a 10% card because Congress acts, the urgency of clearing debt before investing shifts meaningfully. Legislation like this doesn't appear from nowhere. It surfaces when political pressure around a problem reaches a critical mass. And the New York Fed confirmed just last week that U.S. credit card debt has now topped $1.28 trillion. That critical mass has arrived. After high-interest debt, you build the emergency fund. 3 months of essential expenses if you're single with stable employment. 6 months if you've got a mortgage, dependents, or income that varies month to month. This is not an investment. This is insurance. It's the thing that keeps you from selling your index fund at a 30% loss because your transmission failed and you had no other option. I've watched this specific scenario happen. Person builds a solid portfolio. A real emergency hits. They panic. They sell at the worst possible moment. They lock in what was a temporary paper loss into a permanent real one, and they walk away from investing for years. All because they didn't have a few $1,000s sitting somewhere boring and accessible. Your emergency fund is not dead money. It's the thing that lets you stay invested when your brain is screaming at you to sell. That function is worth far more than the 4% it earns. Where does the emergency fund live? A high-yield savings account at 3.5 to 4.5% right now. Nothing exciting, dead boring. Exactly correct. Then you max the Roth IRA. The 2026 contribution limit is $7,000. Verify that directly on the IRS website rather than taking my word for it, because this adjusts and I'd rather you confirm it yourself. Inside the Roth IRA, you buy a broad market index fund, VTI or VOO. They track slightly different benchmarks but behave nearly identically for most investors, and both run a 0.03% expense ratio. The S&P 500 has returned roughly 10% annually over a century. Over any 20-year period in recorded history, it has never produced a negative real return. That statistic holds up. It's real. The compounding math is worth letting genuinely land. $20,000 at 10% for 30 years becomes roughly $350,000. Add $500 a month on top of that, and you're looking at over $1.5 million. You contribute about $200,000 total across those 30 years. Your money generates the rest, around $1.3 million in gains from $200,000 in contributions. The mechanism is real, it is proven, and it works. The index fund is correct. I want to say that clearly before I tell you what's missing from that story. Because here's where I diverge from what you'll find on most channels. And this is genuinely the thing that had me awake late a few nights ago, going back through data I've been watching for months. The US dollar has lost approximately 10% of its value since January 2025, 12 months. The dollar index falling from above 108 to 97 is not noise. That is real purchasing power, gone in a single year. And January 2026 CPI came in at 2.4% year over year, which sounds manageable, and honestly, I was going to move past this number quickly, but I think it deserves a second. The Fed's stated target is 2%. We have been above that target for going on 4 years. Sticky inflation has a track record. It tends to come back. Jerome Powell acknowledged as much after the December 2025 meeting. So here is the math I actually want you to do. Your $350,000 target in 30 years, what does it buy in real terms? At 2.4% inflation sustained over 30 years, that $350,000 in 2056 has the purchasing power of approximately $167,000 measured in 2026 purchasing terms. Not $350,000, $167,000. You followed every step correctly. You were patient for 3 decades. You did everything the playbook said to do, and you arrived with roughly half the real purchasing power the number on your screen implied you would have. That is a significant discrepancy. It is also the conversation the personal finance industry consistently fails to have, because the clean round numbers drive the narrative and the inflation math complicates it. Now, and I mean this, I want to give the fair counter-argument its full due, because it is a real argument. The S&P 500 has historically outrun inflation. Over long periods, 10% nominal returns minus 2 to 3% inflation gives you 7 to 8% real returns. Your purchasing power still grows substantially over 30 years. Long-term equity investors have historically won the inflation game. That is true. I am not disputing it. But here's the piece that argument quietly assumes. It assumes the measuring stick stays reliable. It assumes the dollar, the unit in which your returns are denominated, in which your fund's value is expressed, in which your retirement income will eventually be drawn, maintains enough credibility for the math to deliver what we think it will. And right now, the market is sending a signal about that assumption that I think is worth paying attention to, even if you decide not to act on it at all. When gold goes from $1,800 to nearly $5,600 in less than 5 years, that is not people suddenly developing an affection for yellow metal. Gold doesn't move like that because of fashion or sentiment alone. Gold moves like that when trust erodes. Trust in the dollar, in the institutions behind it, in the idea that paper promises will hold their value across decades. Nearly $5,000 per ounce right now is the market saying something about the dollar, loudly, in a way that deserves to be heard before you deploy your savings. Here's what I find genuinely striking. The buyers driving gold to these levels are not the crowd the financial media likes to portray when it dismisses gold investors, the fringe, the doomsday crowd, the gold bugs. The buyers are central banks. According to the World Gold Council, central banks purchased over 1,045 metric tons in 2024, third consecutive year above that level. China's central bank specifically, 15 consecutive months of purchases, ongoing right now. These institutions have hundreds of analysts, massive research budgets, and information access that neither you nor I will match. They are systematically reducing their dollar-denominated exposure and replacing it with gold. I talked about this pattern a few weeks back on this channel. Some of you pushed back in the comments, argued I was reading too much into central bank positioning, that these are geopolitical moves, not investment signals. That's a fair and reasonable reading. I took it seriously. But JP Morgan's research team, in their latest 2026 outlook, is forecasting gold to average around $5,055 an ounce by Q4 this year. Goldman has similar or higher figures circulating. These are not fringe calls. These are the biggest financial institutions on earth putting their name behind a price forecast for gold. Now let me address the silver story directly, because the last 3 weeks have been one of the most instructive episodes in precious metals in recent memory. Silver hit $121.67 on January 29th, a new all-time nominal high in history. Then, in roughly 2 weeks, it fell nearly 50%. I watched that unfold in real time, and I will be honest with you. Even knowing silver is volatile, even having watched 2011 happen from close range, the speed of this drop surprised me. I remember sitting in my office in 2011, watching silver run from about $18 all the way to $49 in about 8 months. My phone was ringing all day, clients certain it was going to $100, to $200, to the moon. And then it fell off a cliff in a single week. I kept thinking, wait, actually, the fundamentals haven't changed at all. The fear changed. The margin calls hit. The forced selling cascaded from one leveraged account to the next. And a lot of people who had positioned themselves too aggressively got badly hurt in a very short window. Not because they were wrong about silver, but because they were sized in a way they couldn't survive. What happened in January 2026 followed that same script almost beat for beat. A speculative run, overextended positioning, margin calls, historic forced unwind. Treasury Secretary Bessent commented publicly on it, attributed it largely to speculative activity from Chinese traders who got caught the wrong way on margin. The silver market got overrun by leveraged positioning, not by any fundamental shift in the underlying supply-demand picture. The lesson for your $20,000 is not that silver is broken. The lesson is about sizing your conviction correctly. I made a positioning mistake in 2015, got too aggressive on silver when the supply deficit thesis looked airtight to me. Watched it grind lower for 18 months before recovering. It was a hard 18 months. The experience taught me something I have never forgotten. Your conviction and your position size need to match each other carefully. If you hold more than you can psychologically survive seeing cut in half, you will sell at the worst possible moment. You will convert a temporary paper loss into a permanent real one. Size correctly. It matters more than which specific asset you choose. So what do you actually do with all of this information? Because I know some of you are sitting there thinking this is interesting, but where does it go practically? Step 1 is the standard framework, and it is correct. Pay off any debt above 7% interest. Build the emergency fund, 3 to 6 months of essential expenses in a high-yield savings account. Max the Roth IRA and buy VTI or VOO inside it. Set up automatic monthly contributions. Never stop. This is the foundation. It is solid and proven. Step 2 is the step almost nobody takes, and I think it is as important as step 1. Run the real inflation math on your targets. If you want $350,000 of genuine purchasing power when you retire in 30 years, your nominal savings target needs to be closer to $700,000 given current inflation. That changes how aggressively you push your monthly contribution. That changes how you think about income streams in retirement beyond just portfolio withdrawals. The number the compound interest calculator shows you is denominated in future dollars. Know what future dollars actually buy before you set a target and feel finished. Step 3, and I want to be careful about how I say this, is a modest precious metals allocation. Not 50% in gold bars, not loading up on silver after a 50% crash because it feels cheap. A considered, modest allocation. Perhaps 5 to 10% of your long-term savings in an asset that is not denominated in dollars and does not perform like a dollar-denominated asset. Physical gold if you want zero counterparty risk. A gold ETF if you understand that you own a share in a fund, not metal in a vault. A gold mining ETF if you want equity-style exposure to the gold price. Something in your plan that performs specifically when the dollar is under pressure. Because that is precisely when your index fund, your bonds, and your savings account are all losing real value simultaneously. The gold layer has a specific job. It earns its keep in those specific moments when everything else is hurting. I'll be direct. I don't love gold ETFs personally, and I've said that before on this channel. The counterparty distinction matters to me philosophically. But I am not going to tell you an ETF is wrong. Understand what you own and why you own it. That is the standard. Keep watching the credit card rate cap legislation. If it passes, it changes the household debt math for tens of millions of people, and that matters not just personally, but as a macro signal about where political pressure is building. Now, the honest counterargument to everything I just said about purchasing power and precious metals deserves to be stated cleanly. Over almost any 30-year period in modern financial history, equities have beaten gold badly. From 1992 to 2025, $100 in gold grew to about $1,220. That same $100 in the S&P 500 grew to roughly $3,190. Stocks win. If you had allocated heavily to gold over the last 3 decades, you left real significant wealth on the table. I hold that argument seriously. The data is the data, and honestly, they might be right to make that point. The person who put 100% of their savings into a broad index fund 30 years ago and never looked at a gold chart would be meaningfully wealthier today than someone who held a significant gold allocation. That is true. I am not pretending otherwise. But here is the piece that argument consistently misses. The question is not whether gold beats stocks over 30 calm, orderly years. It almost certainly does not. The question is what you're holding during the years that are not calm. During 2008, during 2020, during the 2022 rate shock when both stocks and long-duration bonds fell at the same time. In each of those environments, the standard 60-40 portfolio fractured because both stocks and bonds, both tied to the dollar's fate, fell under pressure simultaneously. Gold held. Not perfectly, not spectacularly, but it held and it gave people options when other assets were giving people fear. The goal of a retirement plan is not to maximize your return in the best-case scenario. The goal is to build a plan that survives the scenarios where most things break at once. Because those scenarios arrive. Roughly once a decade they arrive, and when they do, the person with a small allocation to something genuinely uncorrelated to the dollar's fortunes has options that the person with 100% equities simply does not have. I don't have a crystal ball. I want to be absolutely honest about that. If I did, I'd be on a beach somewhere rather than making YouTube videos at this desk. My read on all of this could be wrong. Gold could fall significantly from here. The dollar could strengthen. Inflation could recede to 1.5% for years. In a decade, this whole conversation might look like overthinking a problem that resolved itself quietly. But 15 consecutive months of central bank gold buying, a dollar index at 97, credit card debt topping $1.28 trillion, and CPI running above the Fed's target for 4 consecutive years, taken together, that is not nothing. That is a set of signals about the unit of measurement your entire retirement plan is denominated in. You deserve to understand those signals before you set your $20,000 on autopilot and check back in 30 years. Build the index fund foundation. It is correct. Max the Roth. Keep contributing automatically every month. And then ask yourself honestly, not ideologically, not because someone on YouTube told you to, whether a small allocation to what the central banks of the world are quietly and persistently accumulating belongs in your plan alongside the index fund. That's the question worth sitting with, not whether gold replaces stocks, whether it belongs next to them. I'd genuinely love to hear where you land on this. Drop a comment. Tell me whether the index fund alone feels complete to you, or whether the gold signal changes how you think about what your savings will actually be worth when you need them. I read more comments than you'd probably expect, and this is exactly the kind of question that generates real, substantive disagreement between people who have clearly thought hard about money. That conversation is worth having. Stay sharp. Protect what you've built. I'll see you tomorrow.